Hello everyone, this is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you my North American opening market comment for Wednesday, July 13th. Well, the big event of the day is the Bank of Canada rate decision. The Bank of Canada is unanimously expected to keep rates stable at this meeting. The market sees about a 25% chance that they do cut at some point before the end of the year. Now, there are lots of reasons for them to ease rates. Most notably, Bank of Canada Governor Poloz was hoping for an export-led recovery, but on the contrary, the April trade deficit was the largest on record, and May wasn't far behind. The labor market, too, is relatively weak. Now, a rate cut would help to weaken the currency and thereby boost exports and jobs. On the other hand, inflation in Canada remains well behaved. It's right in the middle of its 1% to 3% target range. And house prices in some areas are soaring, meaning there are good reasons for the bank to either keep rates stable or even to raise rates. Now, caught between these two competing pressures, the Bank of Canada is likely to just repeat the comment from the May meeting that, quote, the risks to the bank's inflation projection remain roughly balanced, unquote, and keep rates steady. I think that would give relatively little impetus to the Canadian dollar either way. It's probably what people expect. Today's U.S. oil inventory figures from the U.S. Department of Energy were expected to show a fall in inventories of 3.25 million barrels in the latest week. That would be a somewhat larger drawdown than we've seen recently. However, the shocking news overnight from the American Petroleum Institute, the API, of a 2.2 million barrel increase in inventories may have changed the market's expectations. Note that it's not impossible for both figures to coexist. From the beginning of 2015 until the end of March 2016, the two series differed in direction about once every 7 weeks. In any event, the data haven't been showing as much of a drawdown in inventories as expected, and oil prices have been falling as a result. Eventually, either inventories will have to start falling more, or market participants will have to revise their views on demand, which would mean still lower prices. It looks to me like the latter is more likely than the former. Overnight, Australia will announce its unemployment rate for June. The unemployment rate is expected to rise, even though the number of jobs is expected to rise too. The unemployment rate announcement has a major impact on the Australian dollar, and anyone with a position in that currency should watch the number carefully. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.